All right, we do always start off the show, though, with a conversation about the markets. We feel that understanding the investment markets is one of the three key pieces to your retirement, at least from a financial standpoint. You know, you've got your retirement planning, as we'd have a really nice plan that you'd want to have set up. You've got your tax planning, you know, trying to save money there. And then, of course, you've got your asset management. And so that's what this is about here, trying to get you to understand as much as possible, you know, what's going on with the markets and, you know, how to understand even the words, you know, that come out all the time. So this is the S&P 500. This is this big index of 500 stocks, very popular worldwide. You can see I've actually charted this from the beginning of last year, which was the all-time high. We've had all this, you know, run down, but very significantly, we broke through that red trend line, right? That's awesome. We actually had a great January, not so good February so far. Not to be unexpected. If you look at, you know, where that bottomed out was actually back in December, that's a big run. We broke the 200-day moving average in that run. We broke the red trend line there. We had the 50-day moving average come through. We established a new high. I mean, a lot of things happened in that run. That was a very significant run. So to have it pull back, honestly, that's a pretty normal thing. So far, that's all we're doing right now. And if you look close enough, you can see it's pulled back to around 4,000 there. We spent a lot of time at around 4,000 so far over the last, you know, few quarters. And so that's some support there. We'll see if it holds, right? And then we got another big support level there, about 3,800. So again, these are normal things. And actually, when you break through a big trend line like that, you can often see it pull all the way back down to that trend line before it does bounce again. So there's a lot of things to not worry about here, but there are some things to worry about, and so I'll show you what those are too. But in essence, you know, that's what's going on right now. We're just trying to reestablish, we're hoping, a positive trend to the upside here and get back out of this downfall. But, you know, so far we'll have to see what's going on. But this is this week, all right? So I think that's like the definition of the roller coaster ride. Yep. This is every 5 minutes, a chart kind of showing, you know. And so you can see there were some big run-ups, both of which kind of gave back. But mostly it held up until today.
Yep.
And today, you know, it's coming right down on top of my head here. And, you know, today's down because of the inflation report that came out, right? And so let's look at those because this is really important. U.S. PCE Price Index. YOY means year over year. So it means this January versus January of last year. And PCE stands for personal consumption expenditure. This is a really important. Everybody you talk to out there talks about CPI, right? Mm-hmm. CPI is not what the Federal Reserve is really focusing on. They are focusing on PCE. And CPI has gotten all the press, partly because it comes out earlier. It was on
2 weeks, too.
Yeah, about 2 weeks, because it was the 14th. It came out on Valentine's Day, which I thought was kind of ironic. But anyway, PCE is since 2012, the Federal Reserve has been using PCE as their main measure. It is a more comprehensive basket of goods, goods and services. It has a much higher representation of services, whereas CPI really doesn't. Mm-hmm. It looks at replacement things. So in other words, if bread gets too expensive, people stop buying bread, they might go buy something else. In CPI, they never make an adjustment. In PCE, they do. I mean, there's a whole bunch of reasons. So if you want to really understand investing and you really want to understand how the Federal Reserve is going to react, you really need to understand PCE. And again, so much emphasis is placed on CPI. When they talk about lowering, right, the inflation down to 2%, they're not talking about CPI. They're talking about core PCE, which I'll show you here in a minute. But you can see that problem we're having today and the reason it's coming down, it went up, right? Mm-hmm. Not a lot, a smidge. It's gone up before. This is the last year, still overall down. Life is not a straight line, yes, and either is inflation as it comes down. But direction scares the market, right? And maybe even the Federal Reserve. Now, if we take out food and energy, so the Federal Reserve doesn't look very aggressively at what they call top line PCE here. They look at this core. So core PCE takes out food and energy. Well, you can see that's definitely not a straight line.
Yeah.
Right? It's had several bumps upward, even in the overall downward. If you look back a year, it's definitely lower. But but we've had a pretty good jump in 1 month there, right? So that's, again, concerning. But even more concerning is if you look at it a different way, because they look at it year over year, this January versus last, and then they look at it month over month. January of this year versus December of last year, right? And so month over month, that's a pretty big jump.
Yeah.
So it's up 0.6%. And so it's been there before. Actually, if you look closely, this is the third time in the last year it's been at 0.6%. So again, market has broken through all these barriers and all these things have happened, even though those have happened in the past. But you're going to have a market that struggles in this environment. There's just no ifs, ands, or buts about it. And again, if I go back here to the year over year, 4.7%. When the Fed says we got to get to 2%, and then we're going to be happy and we're going to do the right things for the market and whatever they're planning on doing, they're talking about getting that 4.7 down to 2, right? PCE core. So the problem with the month over month is that if you take 0.6 and we had that every month for the next 12 months, not likely, but if it happened, you're actually at 7.2%, right?
Yeah.
12 times 0.6, 7.2. That's going to scare the market.
That's pretty much a disaster.
It is, actually. It's a pretty aggressively disastrous report in that regards. I talked about this last week from the Cleveland Fed does the projections on PCE and CPI. And basically, they're projecting upward motion on month over month, year over year, CPI, PCE, however you want to look at it. And so, that's what we're dealing with right now. And, we saw retail sales were up 3% in January. So it's probably reflective of this.
Yeah, and when you break it down, so PCE is kind of that mix of goods and services. Services, in December was 0.6, and again in January is 0.6. But it's really the difference was non-durable goods. That's where you had 0.8%. Yeah.
So and goods have been falling prior to this, and so goods and that's a little surprising because the Federal Reserve and Chairman Powell talks mostly goods are getting better. He used the word disinflation, and they're getting better, but services are our main concern because there's a tight labor market. We can't get enough people in there. And people are going out and it's shifted from buying goods to buying services like restaurants and hotels and flights and travel and those type of things. So to see non-durable goods, which are things that don't last, like
clothes, paper plates, cosmetics, things that we use up.
Yeah, exactly. Seeing that jump, not super surprising. That's probably where some of this jump in retail sales went to in January. So maybe it backs off, but people are spending money. They're going out, they're borrowing if they have to, and that's not surprising. We've been talking about that for years as a possibility because the pandemic creates this pent-up demand. People got stuck at home, and the Roaring '20s came out of the last pandemic. It's that same thing, and people just get going and start doing more, things with their money and such too. So that's inflationary. And so again, just to be clear, this is what the Federal Reserve is worried about is this number going up. And when the Federal Reserve worries, they raise rates. And so you can see the projection for where they're going to raise rates two places. One place is to look at the yield on the 2-year Treasury. And so I've got that blue line in there. And when it was going down, because inflation was getting better, really like last November, December, et cetera, the market was doing a lot better. It was kind of hanging in there, moving up. We broke through all those barriers based on that. But look at it now. I mean, it had a huge jump, broke through that trend line, but it's now at the high for this time period, around little over 4.8% is the yield. If you really want to understand the stock market, you have to understand also the bond market. And in this environment, the bond market's leading because when we first saw some issues come out with inflation here over the last 2 or 3 weeks, the bond market rates started to go up right away, and the stock market went up too. That doesn't go together usually. Now the stock market's coming back down, so the bond market's leading. Watch the bond market. If you want to know what to do, it's one of the main triggers we use. I mean, we got defensive 2 weeks ago, right? Worked out really well for the most part because of that, at least with a portion of our portfolio, and we'll continue to do so. And then the last thing to look at here is just, what the futures market, what they call the swap market, is projecting for interest rates on the federal funds rate. So the Fed raises this Fed funds rate, and then it goes through to all these other things. Your mortgage is affected by it, credit card, your auto loan if you have one. And so that's now a little over 5.3%. And again, it jumped up quite a bit based on what's happening here. We had a fantastic job report in January, 517,000 jobs. We had a fantastic retail sales at 3.5%, and we got a bigger inflation number than expected, right? And those go together, right? People are getting jobs on whole, and they've got money to spend. As far as so, it's going on. It's a really interesting thing that's happening here. Again, we have a series of triggers that we use to decide when we're going to get more defensive. And so the first things that we get defensive on are inside of our IRAs and Roth IRAs and those types of things because there's no taxes. And we'll wait a longer period of time for the taxable one accounts because, if we take gains, we have to pay tax on it. And we try to avoid that as much as possible. However, you don't want to wait till the point you don't have any gains, right? So there's a kind of a balancing act there. But we're nearing some triggers on being some more aggressive on those positions. So, for example, we went into utilities, high dividend paying stocks, and energy in this last go round, and we're reaching some triggers that are saying, hey, although those are outperforming as a group, the overall market because they've gone down less. They're not outperforming the T-bills, which are basically, not going down. So that's a trigger that we're looking at there. And so we're going to continue to get more defensive if the market continues to fall. I wouldn't be surprised to see some deterioration from the market from here. There's been some damage already just in the last, couple weeks. And then this report today was kind of a big deal. And so, we'll see what happens. But we'll continue. We have a big capital preservation outlook here, even if it means giving up some to the upside. And we will continue to move pieces into more conservative areas, and we'll work on our taxable accounts and those types of things, as those triggers come through. But we try to stay in there as long as we possibly can. And we do have triggers to get back in very quickly, so that's good too. So we'll see how that works out. But anyway, that's what's going on so far with the investment arena this week. Not great news, but we're taking our steps to kind of protect everything, and I think everybody should be thinking about that here. I'm not saying the market's going to collapse or fall or turn into a 20% downturn, but I would not be surprised to see at least continued weakness here. So see how that goes. All right, so good. Thank you for watching this particular summary, and look forward to really covering this again next week.